Well, the first issue has to do with all of these credit default swaps that were unregulated. And back when people were calling for regulation in the market, the Federal Reserve of the United States said there was no need for regulation. And the whole idea behind the credit default swaps was to actually lower risk, because the credit default swap is like an insurance policy. And instead of lowering risk, because there was no regulation of the market, nobody knows who has them, they're all over the world, and we're in a situation where, had we had a central clearinghouse or some type of regulatory body overseeing this particular kind of security, we might not be in the situation that we're in right now. Is like an insurance policy. For example, a company issues a 10 million euro bond issue, and the purchaser of the bonds is worried about the issuer defaulting. So a third party comes in and says, for 100,000 euros, I will issue you a credit default swap that says, if the issuer of the bonds defaults, I will pay you. So what I'm doing is I'm selling you, the 100,000 euros is like a premium on an insurance policy. If you go and you buy fire insurance, you hope there's never a fire, but you buy fire insurance because if there is a fire, then the insurance company pays you for your house. Well, the issuer buys the credit default swap, hoping there's never a default, but if there is a default, then the person who sold them the credit default swap has to pay the 10 million euros that the defaulting bond issuer is not going to be able to pay. So you have, and you have nobody regulating who was issuing these credit default swaps. So you had lots of companies who today don't have the financial capability of paying off on those credit default swaps. So you have all of these what we call toxic securities out there that people thought they were buying to protect their risk, which are now worthless. So in a nutshell, that's a credit default swap. Yeah, the hedge fund industry in the United States wants hands off, and I can understand why they want hands off, because if you are the hedge fund manager, the less disclosure, the better, because if you have a bad quarter or a good quarter, you don't have to disclose the level of detail that you would if you were a publicly traded company. But the problem again has to do with the quality of the hedge fund managers, or the quality of the hedge fund itself. You have such a vast disparity of quality that you don't, if you are a potential investor, you have to do your own due diligence, and you don't have any real basis for is this a good hedge fund or this is not such a good hedge fund, because there's no information other than what the hedge fund gives to you. So I think that now as the new administration comes in, President-elect Obama has announced that he is having a new head of the Securities and Exchange Commission, and I think that she will more than likely have a list of priorities of what the Securities and Exchange Commission should be doing, and my guess is that the hedge fund, the lack of regulation of the hedge funds will be something that will be high on her list. Well, my understanding is that this was a person who well respected and well trusted in both the financial community and within his social community. And I'm not sure when he decided that he was going to commit this fraud, but it is a typical pyramid scheme fraud. And what happens in a pyramid scheme is you bring in the first investors and you promise them a return, and if you don't make the return, you don't tell them that you haven't made the return. You just bring in a new set of investors and take their money to compensate the first set of investors with the return that you promised them. Now the second set of investors are in, you've promised them a return, and if you don't make the return there and the return for the first investors, you'd better bring in some more investors in the third tier. And so what you have is a pyramid. The people on at the top of the pyramid are not doing that badly, although at the end, when it collapses, their principal is gone, but at least they've received some payments. The people at the very end are the ones who get nothing. They were the ones who came in last, who helped him pay the first investors, second investors, third investors. They get no return, plus they lose all of their principal. At least my understanding is that as early as 1999, the Securities and Exchange Commission in the United States had some information about about Mr. Madoff. I like to call him Madoff because he made off with a lot of money. But as early as 1999, there was some suggestion that the returns that he was claiming to have made were not real, but the Securities and Exchange Commission took no action. And then my understanding also is that the last time they looked at his books was in 2006. It's now almost 2009, so he's had 2 years of nobody really looking at his books. The idea that he perpetrated the fraud on his own is something that is bothersome. The magnitude of the fraud just suggests that somebody else had to know, and he claims nobody else knew. He may be protecting other people and figuring that he's going down anyway, so I might as well just go down by myself. Now, coming back to the Spanish banks, I think that they were duped just like the non-Spanish banks. I think my understanding with respect to Banco Santander is the loss could be as high as $3 billion or 2 billion something euros. And more than likely, they were not in the first tier of investors, but more than likely they weren't in the last tier of investors either. I think that the real implications are for the charitable organizations that he got to invest with him. They're losing millions of dollars. That's their entire budget. So while it hurts Banco Santander and the other Spanish banks, I think that they'll recover from it. Not easily. No, that kind of a loss is still a significant loss, but I think that they'll be okay.